Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Brad Smith alongside Madison Mills. Let's get to the three things that you need to know today.
First up, U.S. stock futures falling this morning following the latest release of key economic data. GDP numbers showing the U.S. economy shrunk by more than expected in the first quarter, marking the economy's first economic contraction since 2022. Meantime, the Fed's preferred inflation gauge, core PCE, showing inflation rose 3.5% in the first quarter. Economists expect monthly data due out later this morning to show inflation slowed in March.
Plus, President Trump marking his first 100 days in office by celebrating his economic policies and tariff regime while reigniting criticism of the Federal Reserve.
Interest rates came down despite the fact that I have a Fed person who's not really doing a good job, but I won't say that. I want to be very nice. I want to be very nice and respectful to the Fed. You're not supposed to criticize the Fed. You're supposed to let him do his own thing. But I know much more than he does about interest rates, believe me.
The president's remarks come after he said he had no plans to fire the Fed chief and signed directives easing some of his planned tariffs, including a 2-year reduction in 25% auto parts levies for components used in cars and trucks finished in the U.S.
And investors will get the latest insight into big tech profits today with two Magnificent Seven members reporting. Meta's first quarter results will offer the first financial update since President Trump's tariff announcement, which may impact the social media giant's global advertising and hardware businesses. Meantime, Microsoft expected to provide insights on data center spend plans when it reports fiscal third quarter earnings today after the closing bell.
Well, U.S. stock futures are lower across the board this morning. For the U.S. major averages, we're taking a look at some declines of 0.8% for the Dow, 1.3% for the S&P 500. NASDAQ futures down 1.9%, just inside of 30 minutes until the start of trade. We've got some fresh data Wednesday morning showing the U.S. economy contracted for the first time in 3 years as President Trump's trade policy took hold. GDP decreased at an annualized 0.3% during the first quarter. This is according to an initial estimate. An upturn in imports subtracted nearly 5% from the metric, the most on record. Gus Fauché, who is the PNC Financial Services Group Chief Economist, joins us this morning. Gus, I just want to get your reaction to this print this morning.
This is very difficult to interpret. I mean, obviously, trade was a huge influence. We saw companies bringing in a lot of imports to try to get ahead of tariffs. We saw a huge build in inventories. But when you look at underlying demand, consumer spending growth, that was still pretty solid. So it's going to be interesting to see what happens over the next couple of quarters and whether that solid demand holds up, or whether we start to see consumers pull back, businesses pull back because of tariffs. But I think overall, this is indicating that tariffs are having an impact on the economy, that it's been negative so far in 2025, and they're likely to remain negative in through the rest of this year.
Gus, as an economist, you know that the definition of a recession is a little bit more broad than what I'm about to say, but the kind of colloquial definition is 2 consecutive quarters of negative GDP growth, and then the NBER has a ton of other things they look at, and they declare an official recession. Is this morning's GDP contraction a signal that we are on track for that recession?
I don't think so, because when you look at the broader indicators that the NBER is looking at, employment, industrial production, retail sales, consumer spending, they all look positive. So this quarter of contraction, that's due primarily, almost entirely, to net exports, the fact that we had a lot of imports coming in. I don't think this is indicating that the economy is close to recession right now. We would need to start to see some softness in those other things, in employment, in consumer spending, in industrial production. We're not seeing that yet. And I think when you look at the deeper into it, I think the economy is still expanding, just that trade is having very broad influences that are making the numbers difficult to interpret.
You know, Gus, with that in mind, on the employment front, we did get some private payrolls data out of ADP this morning. Private employers adding 62,000 jobs in April. And as you were thinking about employment and reading through even some of the commentary that we're receiving over the course of this earnings season from CEOs, their outlooks are not clear at all, it seems, at this juncture, which could have a broader overhang in the near term or long term for some of that employment situation. How are you kind of pairing some of those comments with how they're looking through the workforce that is necessary for their operations right now?
That's right. I mean, we continue to see initial unemployment insurance claims that are low, so we don't see a lot of layoffs, that are related to tariff activity. I think that businesses are waiting to see what happens with tariffs. They're not doing a lot of hiring, but at this point, it doesn't look like they're laying workers off either. As long as we continue to see employment increase, that means household incomes are going up, consumer spending is going up, and the economy should continue to expand. But if we see businesses that are being negatively hit by tariffs, if we see them start to cut back on employment, then I think we have to be much more worried about the potential for recession in the U.S. economy.
And Gus, the market is currently pricing in about 100 basis points of cuts this year. How much more pain do you think the economy would have to be in to get that degree of cuts from the Fed?
Well, certainly we'd have to start to see some deterioration in the labor market, and that hasn't happened yet. But I do think that over the next few months, if we start to see initial unemployment insurance claims increase, if we start to see weaker jobs reports, maybe job growth slowing to well below 100,000, the unemployment rate starting to increase, then maybe we could see the Fed start to cut sometime in the second half of 2025. But given the inflationary impacts of tariffs, I think they want to see some sort of deterioration in the labor market before they start to cut again.
And Gus, I want to get your reaction to a comment that was made by President Trump at a rally on Tuesday. Trump continuing his criticism of Fed Chair Jerome Powell. Take a listen.
Interest rates came down despite the fact that I have a Fed person who's not really doing a good job, but I won't say that. I want to be very nice. I want to be very nice and respectful to the Fed. You're not supposed to criticize the Fed. You're supposed to let him do his own thing, but I know much more than he does about interest rates, believe me.
Spoken like someone who spent their career in real estate. Gus, to what extent do you think there is a real concern, especially amongst investors kind of fleeing U.S. assets to a degree, about the Federal Reserve's independence?
I think that is a legitimate concern. I think that one of the things that has served the United States well is the independence of the Federal Reserve from political pressures. I think it's highly unlikely that President Trump would actually try to fire Chair Powell, but certainly Chair Powell's term expires next year. I think that the president will try to replace him with someone who's more on board with the president's thinking. And I think that that doesn't bode well for U.S. long-run economic growth if we see more political control over the Fed.
Gus, thank you so much. Appreciate your time. Well, lingering uncertainty surrounding the president's trade war has investors on edge, with historic sell-offs followed by record rebounds. So how should investors navigate the volatility? Joining us now, Ritholtz Wealth Management Chairman, CIO Barry Ritholtz, and author of the new book, How Not to Invest, the Ideas, Numbers, and Behaviors That Destroy Wealth and How to Avoid Them. Barry, I'm so excited to chat with you.
Thank you so much for having me.
So talk to me about how investors should not approach this moment. What should investors not do amid a trade war, amid record uncertainty?
So there's a little bit of it depends. Let's assume you're not retiring in the next 12, 18, 24 months, but you have a kid and you're saving for college in a 529 plan. You won't touch that money for 8, 10, 12 years, or you're saving for retirement in 10, 20, 30 years. You have to ask yourself, is this worse than the great financial crisis, the pandemic, the dot-com implosion and 9/11 that happened at once? Those were really horrific disruptive events, not just to the country, but to the markets, to the economy, and eventually you work your way through it. So don't engage your limbic system. Don't engage in that fight or flight response just to make the nervousness go away. You certainly can ask yourself, hey, am I really nervous because maybe I'm overexposed to equity? Maybe my portfolio is way too aggressive. But if you're not touching this money for 5+ years, you have to look through this administration to the other side. This is a chaotic, volatile mess, but we've been through worse, and we'll get through this, more or less intact.
It's interesting, Barry, especially given what FactSet was kind of noting at the start of this earnings season, which is, could you potentially see companies to the same extent during COVID-19 and the pandemic pull their guidance and issue to investors, signal to the street that they don't have clarity, and then that send more concern through the investment community, which is exactly what we're seeing play out.
Thank you for using the word clarity. I hate the word uncertainty because it's always uncertain. You never really know. But you generally have a sense. I think two of the big airlines that reported earnings.
Delta,
and
Southwest,
JetBlue and South. So what they're seeing is all this soft data, sentiment data, starting to turn into hard data actions. So when people are at home thinking about booking a flight, you don't book a flight to go on vacation next week, you book it off in the future. Hey, this is crazy. I don't know if I'm gonna have a job. I don't know what my bonus is gonna look like. Maybe we should hold off on booking that family vacation to Disneyland. So everybody seems to be a little frozen in place. It's not just households. When we do see surveys that the Fed does and the Department of Labor and Commerce does of corporate CEOs and CFOs, what are your hiring plans? What are your building plans? What is your capital expenditure plans? What's your CapEx going to look like? Everybody is like, hey, we have to wait for the dust to settle to get some clarity, and then we'll figure out what happens. I'm not a believer that we can talk ourselves into a recession. That always seemed too cute. But if everybody is frozen because we have no idea what's going to happen, tariffs are on, tariffs are off, they're 10%, they're 100%, they're 25%. All right, we're carving out exceptions for iPhones and cars. Like, hey, when the dust settles, we'll see this is a very strong economy, at least up until April 2nd. When the dust settles, there's no reason to think it won't resume, assuming we don't have a really unnecessary, unforced error.
So how do you invest around that environment? And I keep trying to remind myself to flip it to the negative because that's your book.
How don't you invest?
Things.
Right.
And I wonder too if you can explain to me whether your advice or insight changes for retail versus institutional. This is something Scott Besson talked about yesterday, that retail is buying the dip and it's the institutional guys who are ruining everything. How does the advice differ?
So buy the dip works until it stops, and then you go through a period where, you know, I just put out a market commentary on Monday talking about, hey, I know no one believes this, but the past 15 years have been amongst the best 15 years in the markets that we've ever seen. You have to go to the 15 years right after World War II and the 15 years that right before the dot-com implosion in 2000 for 18, 17 versus this 16% a year. And so when you're thinking about this, you really have to remember how much everybody hated the markets in the 2010s because the recency effect, because their most recent experience was, oh my God, the market crashed. Now their most recent experience has been the markets pretty much have gone straight up for 15 years. Yeah, we were down double digits in 2022 along with bonds. That hadn't happened for 40 years. And then, you know, the pandemic, 17 days down 34% with a quick recovery. But buying the dip has worked, and it'll continue to work until it stops. We're overly focused on what just happened. So what not to do is recognize, just look at 2023 and 2024.
Yeah.
Back-to-back 25% years. We tried to do research on that. It's so rare that we had to use a data set of back-to-back 20% years.
Yeah.
And when you get 5-6 years of returns in 2 years, the forward expectation is, hey, lower your targets, reduce your expectations. If we, in January, I told clients, if we see 5 or 6% this year, I'm thrilled.
Yeah.
You know, Barry, it's interesting. In one of your answers a moment ago, you acknowledged two major technological disruption periods and cycles that we had seen in the past. Both within .com, we could add cloud within that as well. And they were eventually turned into show me stories where all of these major investments and announcements were made up front, and then companies had to prove to Wall Street that they were actually able to grow into those multiples, that a lot of the hype phase sent their stock multiples skyrocketing over. Where are we at for the AI cycle within that too? Because that's where investors had really used that catalyst as a general thesis for their portfolio.
So everyone wants to pick the winner in whatever the new thing is.
Yeah.
So whether it's AI or mobile or genomics or go down the list of all the technologies that are driving so much of the economy. But we sometimes get hyper-focused on the Magnificent Seven, NVIDIA, when, you know, we used to talk about internet companies. Hey, everybody's an internet company. Everybody lives on email, has a website, uses digital. And so when we look at the hype around a handful of AI companies, maybe we should focus less on the Magnificent Seven and ask ourselves, what are the productivity, efficiency, creativity gains from AI going to mean to the remaining 493 companies in the S&P 500. Potentially, it's going to make those companies more productive, more profitable, and more valuable. I think NVIDIA is the first company to lose $1 trillion in market cap, at least the first US company. So maybe they're the winner, maybe they're not. It's throwing a dart with a company like that. But you have to think about, hold what your Luddite friends are saying about, no, everyone's going to get fired and the world is going to hell. The way I look at AI is it's a collaborative tool that's just going to make all of us more efficient.
Barry, we've got 30 seconds left, but I want to get insights on Buffett and Munger. Cash holding right now, a huge thing of interest for our audience because of Buffett holding a bit of cash. Is he making the smarter move?
So he's a unicorn. Most managers that hold a ton of cash, you get a month where the market goes up and their clients are screaming at them. There are a few people in America named Warren Buffett who could get away with saying, hey, don't market time. He tells people just buy broad indexes, but I'm going to take some money off the table because I think opportunities are coming. Who's better than Warren? I mean, the average mom and pop investor should not try and do what Warren Buffett does. Literally one of a kind in all of financial history.
Barry, great to have you here with us today, and congratulations on the new book as well.
Thank you
Author
so
of the new book, How Not to Invest. We appreciate you taking the time in studio.
My pleasure. Thanks for having me.
Coming up on Morning Brief, everyone, we count you down to the opening bell on Wall Street, plus super micro shares plunging following earnings. We break down the results, and guess what? Later on this hour, we sit down with the CEO of Starbucks. Shares right now of the green siren sinking after earnings. All that and much more on Morning Brief. Now time for some of today's trending tickers. We're watching Supermicro, Visa, and Snap. First up, Supermicro issuing weak preliminary results for its fiscal third quarter. The server maker says some customers delayed their purchasing, moving sales into the current fourth quarter. The results fueling worries of a pullback in AI investments, and the company is going to hold a conference call to discuss the results on May 6th. Shares right now plunging down 20%.
Yeah, I mean, if an AI darling that runs the server projects that AI projects need is experiencing a demand problem, of course, that presents a potential problem for the other AI names in the space, and we are seeing some of that weakness coming in with the tech-heavy NASDAQ getting down today. All right, well, next up, Visa topping second quarter earnings expectations boosted by resilient consumer spending. The payment processor left its 2025 financial outlook unchanged. The company also authorized a new $30 billion stock buyback program over several years. Shares, though, down nearly 2%. The profit falling, potentially one of the sticking points off this report.
Yeah, a few figures that I'm going to run through here just briefly, as the company's CEO was talking about some of the strong 9% second quarter net revenue growth driven by healthy trends in payments, and then additionally the cross-border volume here and processed transactions. They also mentioned within this that consumer spending from their lens remained resilient even with macroeconomic uncertainty. And just to briefly put a number on this, that $9.6 billion net revenue fiscal second quarter figure, that was an increase of 9%. They say that's driven year over year by that payments volume growth. And then additionally here, taking a look at some of the cross-border volume, excluding transactions in Europe, that ultimately increased by about 8% in the year over a constant basis, and then, 13% on a constant dollar basis for the cross-border volume there. And then just lastly here, we do want to take a look at Snap, the brand of Ghostface Chilla, reporting better than expected first quarter revenue, but withholding guidance for the second quarter, citing some macroeconomic uncertainty that could hit advertising demand. Still, the social media company reported 460 million daily active users during the first quarter. That's up from the 453 million in the previous quarter here. Shares are actually down right now by about 15%. And for anyone listening into the earnings call, I kind of zeroed in on one thing that might need a little bit of clarification because it's a major growth element for this business, and they talk about it as doctor revenue on the company and doctor advertising. They're really just talking about direct response advertising. This is something that they have really invested heavily into those solutions over the past several years. New formats like dynamic ads, new technology like shoppable augmented reality, so AR lenses, and driving some of that meaningful ROI. So just wanted to clarify that for anybody listening in and being like, man, I didn't know if there was so much healthcare advertising on Snapchat. Right? It's not that, it's direct response.
It's a really good point, and we're going to continue to talk about that later on. We've got an analyst on the stock, but you can scan your QR code below to track the best and worst performing stocks with Yahoo's trending tickers page.
In the past 90 days, tariff mentions on earnings calls soared 132% on those earnings calls as executives grappled with ever-changing trade policy, according to analysis from Barron's. Joining us now to discuss that backdrop, we've got Bill George, former Medtronic CEO, Harvard Business School executive fellow as well. Bill, always a pleasure to grab some time with you here. Just take us into your analysis of how you're hearing CEOs position their companies and position the commentary around their operations amid what is a very unclear environment beyond the current quarter we may be in right now.
Brad, I've never seen so much uncertainty among CEOs about what to expect. Tariffs are changing every day. Look at Mary Barra. One day it's a big tariff on automobiles. Next day, well, maybe we'll hold off on tariffs on aluminum and steel. So how do you project your costs? How can you really calculate what it's going to be? And so I think that's why people are withdrawing guidance. We're starting to see some cracks. Look, the economy has been very strong, but I think the fact that GDP was down 0.3% in the first quarter is a signal. Private payrolls are down. We know the government payroll is going to be down. So I think we have to look at these signals. The market seems to want to go up on any signal that things are going to be better, any negotiation. The administration's promising one of these. I personally think it's going to take a lot longer. So this lack of clarity on tariffs is going to cause a lot of CEOs to hold off on investments. They're not going to do M&A deals. They're not going to invest in new factories. Some of them are announcing a 10-year plan to invest heavily. That's fine. But in terms of actual shovels in the ground, I think you'll see them holding off on new projects for a while until they get some clarity.
Well, CEOs are heading to the White House today in an attempt to get some of that clarity, Bill. To what extent do you think that the CEOs and in the conversations you're having with them, to what extent do you get the sense that they have any influence over what the White House does on tariffs?
Well, two things. This president really believes in tariffs. He has all of his professional life. On the other hand, he does listen to people in his office. So I think they'll have some influence. We've seen people go to the White House and then they get some kind of relief, whether it was Tim Cook at Apple, I think we'll see the same thing today with the CEOs. But how long that's going to last and the uncertainty, that's what's clouding. I think CEOs want to invest. They want to invest worldwide, but I think that's a real concern. And now we're seeing some cracks in earnings. The airlines down. We see Pepsi pulling its guidance, and others are doing the same thing. The banks are faring well because of the trading side. Barclays just announced this morning that a very strong quarter. But on the M&A side of the banks, whether it's Goldman or JP Morgan or Barclays, the M&A side is very slow right now. Yeah. So I think it'll take a while because these deals are not really even in the pipeline right now. So I think they're going to see CEOs waiting to get some clarity. And it's got to be consistent clarity over a period of time. It's not just a promise one day.
Well, Bill, it sounds like some of the CEOs in an industry that you're very close with in healthcare as a former CEO of Medtronic, they could be on high alert in the coming days, weeks, as it seems like pharmaceuticals are one of the next areas that could potentially see some action on the tariff front. I imagine you're still having a pulse with some of the CEOs that are in that sector, in that space. What are you hearing from them?
Well, I was in touch recently with two very large pharma companies, and they're very much in a wait-and-see mode right now. They're concerned because they got a reprieve on the first round, and now they're being told, well, there's going to be tariffs on pharmaceuticals. So they're kind of wait and see. But I think the bigger issue for them is the changes in R&D. And you're seeing these cutbacks. I was at Harvard last week, and the impact on them of the cutbacks at Mass General and the Brigham, which flows right into the pharmaceuticals, and the cutbacks at NIH and overhead is affecting every academic medical center, which is going to flow right into the life science industry. I'm really concerned about this industry for a whole different reason, and that has to do with research that they need eventually to turn into new products. And we're seeing this pretty much across the board. So I worry about a great deal. And the cutbacks of the FDA means that approvals are getting slowed. And so I worry about that as well. So I think it's pretty much a wait and see for the pharmaceuticals as well.
Bill, we got about a minute left. What you're saying reminds me of something that I remember from one of your books. You said that some CEOs change their values to meet the moment. Others are sort of solidifying their current values. Who wins? The CEOs that push back against the administration to protect things like the FDA versus the CEOs that capitulate to protect their stock price?
I think it's clearly the CEOs who are clear about their values and their purpose. Anticipatory compliance with what might come at you as target practice is not going to work. I think organizations like Costco that reaffirm their values are going to do much better in the long run, because your employees, they have huge numbers, hundreds of thousands of employees. The employees don't know what to think. They thought these are the values. Now, why are they pulling back? And I think that doesn't lead to more response. Customers, same way. They get confused. So I feel very strongly, and I say to every CEO, stay true to your values. You got to run the company so that it's going to be around for another 100 years. You need to make decisions now rather than trying to avoid a short-term hit. Go ahead and take that hit if it means stand up for what you believe.
Bill, great overview. Hope you'll come back soon. Thank you so much.
Thank you, Madison.
We're going to have all your markets action ahead. Stick around. You're watching Morning Brief. That's the opening bell on Wall Street. Let's get it over to Yahoo Finance's Jared Blickery for a look at what's moving. Hey, Jared.
Well, thank you, Maddie. Well, we got the S&P 500 and the the Dow and the Russell 2000 up 6 days in a row. I want to show you what's happening in the month of April here. 21 days. We are down 2.22%, but we were almost at the unchanged earlier. Let's check out the NASDAQ, and we can see that's pretty close as well. So we'll have to see what happens into the close today. But I want to get to the bond market real quickly. We saw that GDP whiff, and that kind of sent things down. We've had some volatility in the Treasury market, and here we just got a little bit of a blip right there. I want to move on to some of the sector action because we have staples and healthcare leading today. That's kind of a defensive setup, and we have consumer discretionary and tech, and also energy leading to the downside. So mega caps really taking it on the chin here. Let's do a month-to-date recap real quickly. We see only utilities and staples in the green. Energy the worst off, down 13%. Worst month for energy since June of 2022. But I want to get to the NASDAQ 100 here, and we'll get back to our intraday look where we can see some of the, a lot of weakness on the board here. Tesla down almost 5%, Amazon down 3.5%, NVIDIA 4%, Meta 4%. So looking at a little trouble to end the month here, but sometimes we just see some random gyrations at the very end. Back to you guys.
All right, Jared, thanks so much. Appreciate it. Starbucks falling this morning after reporting weaker than expected second quarter results yesterday after the close, as the company says its turnaround plan is still brewing. Let's toss it on over to Yahoo Finance executive editor Brian Sozzi for his conversation with Starbucks CEO Brian Niccol. Soz.
All right, thanks so much, Brad. Brian, always nice to get some time with you after this earnings day. I'm sure you saw that GDP contracted 0.3%. The first decline since 2022. Through the lens of Starbucks, Brian, does this look like a contracting U.S. economy?
You know, look, that's a great question as it relates to what we're seeing in our Starbucks business. And, you know, if you look at our results, what I'm seeing actually is a step up in transactions as it relates to our business in the U.S. We had our best quarter as it relates to sales comp in the last 5 quarters. And so we're continuing to see progress in the Starbucks business with customers. And that's going to continue to be the case. And that's what is part of a turnaround is, you know, you stabilize the business and then you build back better with our customers and with our partners in the store. And that's what we're under the game right now. And that's what we're after doing.
Brian, but the North America same-store sales still down 1%. When the Starbucks customer comes into the stores in this economy, are they pulling back? Are they perhaps reaching for a hot coffee instead of a larger iced one? Are they not buying the pastry?
You know, we're not seeing a change in the basket. So when they come in, the attach has been pretty much the same as far as customization or adding on food. And, you know, I think, frankly, what we're focused on is how do we bring customers back into our stores so that they experience a great seat, a great vibe, they get that connection with our baristas, and then they obviously get the craft beverage that they want on the right speed of service. And that's really what we've been making progress on is, and I think at the end of the day, our great craft with our great barista connection and these terrific coffee house experiences are what sets the brand apart. And that's what's going to be the foundational piece that turns this business around.
Brian, why do you think there is that disconnect? Just listening to what you're saying trend-wise, of course, I know you sit on that Walmart board too as well. Just given your vantage point, why do you think there is still that disconnect between what the economy is doing and what you're seeing inside of Starbucks?
Yeah, look, I think consumers obviously are feeling some pressure. There's no doubt that you're seeing consumer sentiment go down over the last couple months. But I do think they're still being very choiceful in where they want to spend their money. And, what I want to make sure is I give them the experience where they feel great about the dollars that they spend at Starbucks. And that's what we're focused on. If we can give people a differentiated experience with great coffee, great drinks, great food, they will continue to come back and they will allocate their hard-earned dollars to the Starbucks business. And, that is what we need to deliver on, and that is what we need to make sure the customer is saying to us, which is, you guys are giving me a great experience, you're giving me the great products that I want, and you're doing it on my time schedule. I think, we'll continue to always get more than our fair share of that wallet, and that's what we're after.
Brian, you mentioned on the earnings call last night being, quote, disappointed in the corner. Is the turnaround at Starbucks taking longer than you thought?
Look, I never like to have negative sales or earnings that aren't growing. And so we got to be honest with the reality is the results weren't great in the quarter. But when you look behind the scenes, there was a lot of great things happening, okay? We said the Back to Starbucks program was all about getting back to great speed of service or throughput and great connection in a great coffee house with engaged partners that are set up for success. That's what's happening. If you look at the algorithm test for technology, we've taken about 2.5 minutes out of the cafe drink experience. If you look at the drive-through, I think we've pulled out close to 30 seconds of speed in the drive-through, so now pretty much every order is less than 4 minutes there. We've improved our on-time and accuracy in the mobile order. And then we've really got a lot of understanding of what the right staffing levels are, the right deployment, so that our baristas are set up for success to do the craft that they love to do and the connection that they love to provide. Whether it's writing on the cups, saying hello, at the handoff, or just knowing their customer's order. So, look, there's a lot of great things happening in the quarter. The results, not where we wanted them to be, but the progress on the Back to Starbucks plan, exactly where we want to be.
Yeah, we're seeing the stock move, Brian. I mean, it's down, last time I checked, double digits, so under pressure. And, from the folks that I was able to talk with, they were surprised by that North America same-store sales down 1%. I mean, do you have a timeline on when that business is back to growth?
Look, I think the timeline is when we start delivering great experiences for our customers and set the partners up for success to deliver those experiences, you will see the business grow accordingly. And that's what we're working on. And I'm confident, that's what's in our future. I think you're going to see us grow, not just the top line, but also the bottom line. And this is what I keep talking about. It's like earnings is an outcome of us doing the right things in our business, both from a culture standpoint, a people standpoint, and a customer standpoint. We do all those things right, we'll get growth on the top line, and obviously we'll do everything we can to make sure that that growth travels to the earnings.
The next two quarters, Brian, should Starbucks be judged more on same-store sales or earnings?
I think we should be judged on the progress that we're making to turn this business around. And I think you'll see it manifest itself in a lot of different ways. There's more than just a comp metric and an earnings metric. And I think you're going to see those metrics start to move in the right directions that will then be the leading indicators to say, look, a lot of good things are on the way for the Starbucks business.
You mentioned that you are reviewing your store base. Of course, you have your new CFO in there, Kathy Smith, who I know from her time at Target. Does a review mean hundreds of store closures?
So what a review means is we got to look at where we have invested money in these stores. Have we done it correctly? And, obviously it can result in some closures. It can result in some renovation. And so those are the things that we have to evaluate. As I mentioned on the call, we are looking hard at what are the costs that are necessary to do a great renovation program. What are the costs necessary to do the right new store builds? And so as we've evaluated what we think that is going forward, we know we got to change versus what we've been doing in the past. And so what I inherited is not a great renovation program or a great new store build program. So we're going to fix it. And that's what the plan is to fix just that. And so we'll do it accordingly. You'll see us do some simple renovations where we can make the coffee house look great again, give people a great seat. We'll obviously be investing in the labor. We'll be investing in the technology behind the labor. So I'm really excited about the work that's to come on our whole building program going forward.
When I walk into the Starbucks of the future, Brian, what will it look like?
Well, look, what I would hope you experience when you walk into the Starbucks of the future is a great coffee house vibe. It hits you right away. Whether you're coming in to just grab your coffee and go, or if you're coming in to chat up with the barista and sit and stay, I think you want to feel like you're in a special community place. Starbucks has the ability, I think, to make the community space come to life yet again. And I frankly think it's part of the reason why the brand is so important in the world. The world needs these third places. It's where people come together at a local level, support each other, and frankly, just have that connection that I think, frankly, is too lost in too many places. And so that's what you're going to feel. Obviously, you're going to get great craft. You're going to get great coffee. You're going to get service from baristas that care immensely about the work that they do. And then we're going to give you a great seat for whatever occasion you want to experience in our dining room. And then we'll also set you on your way if you want to come through the drive-thru quickly, or you need a mobile order to just be on time for you so you can grab your coffee and go. But that's the Starbucks we're going to be creating in the future. It's going to be one that stands for community, connection, craft, and I think people are going to be really proud to be a part of this brand, and hopefully customers are going to be really excited to be a part of the brand.
Brian, lastly, the Trump administration has made a point in its first 100 days to meet with a lot of manufacturing CEOs. President Trump has also met with a lot of retail CEOs, I believe Walmart, the CEO of Walmart and Target recently, but he hasn't met, I would argue, with service companies like yours. And if he has, not the size of Starbucks. As you look at the past 100 days under the Trump administration, how much more complexity has this administration brought to your life as CEO? I mean, I look where you get your coffee beans from. Arabica coffee beans from, Brazil and Colombia, those are now getting tariffed. Wages, prices for other things are going up. Like, what has it been like sitting in that seat of yours?
Look, I think the CEO seat is one of those seats that comes with great responsibility and the world in which we operate. And Starbucks is a global business. It's a global iconic brand. It's got, a lot of complexity, but also tremendous opportunity. And, that's how I always look at these things. I view the world as a place that's always going to be changing. It's always going to be evolving. And what my job is to figure out how we manage through that change. And, hopefully we're in front of the change, we're in front of culture, and we're keeping our business relevant for all constituents. And so that's why I love these jobs. I love being a part of Starbucks at this turnaround phase. I love being a part of a global iconic business because we have the scale, we have the ability to mitigate, pivot, take advantage of opportunities that we see in front of us, and then obviously course correct where we got to course correct. And, that's the type of leadership team that I've built here. We've got a lot of agility. We've got a powerful brand. And, I consider myself fortunate to have this job. And look, I kind of really enjoy the complexity and the challenges.
Somewhat related, Brian, that lavender coffee that's on the menu, I tried it last weekend on my local mall. You pulled it off. I thought I was going to absolutely hate it, but you guys made it work, so I had to for you guys. Brian Niccol, Starbucks CEO, always good to see you. Talk to you soon.
Yeah, great seeing you, Brian. I agree with you. The lavender's a sleeper. So
yeah,
I'm glad
yes,
you tried it.
Sleeper, yes, indeed. Maddie, back to you.
Take care.
All right, thanks to Starbucks CEO Brian Niccol and, of course, to our own Brian Sozzi for the great conversation. As we do head to break, let's get a check-in on the major averages here falling after the U.S. economy posted its first quarterly economic contraction since 2022. And you've got that selling really kicking off in earnest after the opening bell on Wall Street here. You've got your S&P 500 off 2%, but your tech-heavy names taking the majority of the pain this morning, down about 2.7% at the moment. Much more ahead on Morning Brief. Shares of Humana opening the trading day, flipping around a little bit this morning, but up to the upside at the moment after reporting first quarter earnings that met Wall Street's expectations. Yahoo Finance senior reporter Anjali Kemlani has the details. Hey, Anj.
Hey, that's right. Numbers are as good as expected, as you mentioned, from Wall Street. So take a look at what we've got. $32.11 billion in actual revenue compared to $32 2.15. So as you can see, really close on those numbers. And then adjusted EPS, a beat there, slightly so. And what that means really is that Humana's book of business is coming in par with a lot of the changes that help them sort of restart the new year on a different note, which includes moving out of certain areas where they offer the plans. And Medicare Advantage has been a really particular pain point for a lot of insurers in the last year. This clearly a change. We saw United Health with a little bit of pain, Elevance came out with a little less pain, and now Humana signaling that there might not be as much pain in the Medicare Advantage book this year based on a lot of different factors. We heard from Jefferies analysts saying Humana's results should be a calming influence. Its first quarter was largely uneventful, and they did reaffirm guidance, so that's also more good news. I want to take a look at their MLR, that's their medical loss ratio. The Affordable Care Act basically ensured that insurers are supposed to spend a portion of the premiums that they receive, and that portion for large plans like Humana is around 85% that they're required to pay out. The good news is that they have exceeded that in this quarter, and they look to actually be on the higher side. Now that 90.5 estimate, they mentioned in the call today that it is going to be because each quarter they do see sort of a little bit more increased expenses from plan members. So by the time they reach the end of the year, it should reach that 90.5. Good news for patients, bad news for investors who are looking for a lower number on that side always. But because the book of business is so heavily in that Medicare business, whatever costs happen, whatever senior utilization is like, that's something that Humana has to contend with. So all eyes on this one to see whether or not what we saw in United Health is going to be a continuing trend. Clearly not as of right now. And then the last one that we're going to have to wait for is going to be next week with CVS and Aetna, and to see if their book of business tells us what the actual story is.
Anjali, thanks so much for breaking this down. Appreciate it.
Of course.
Shares of Caterpillar, they are fluctuating here this morning as it's been oscillating between gains and losses. As of right now, it is flat, just barely to the downside after the company missed on earnings but reported record organic backlog growth of $5 billion in the quarter. Shares, as you can see right now, they are sitting flat, just about 0.2% lower. Here's a look at the actuals versus the estimates here, and it was a beat on revenue, slight miss on adjusted EPS, or excuse me, miss on revenue and EPS as my own kind of vision is calibrating here. One thing that my vision doesn't have to calibrate very much around is all of the parentheses around some of the segments and geographic region breakouts that the company puts within its earnings report. There were, and that's not a good thing, by the way. That just means that you saw a year-over-year decline, notably construction industries across every segment and every region, geographic region, saw declines. Here in the U.S., or North America rather, it was down by 24%. And then additionally in EMEA, or the European region, that was down by 13%. Latin America, 15%. Oh yeah, down 12% in Asia Pacific. What does this spell out? Not a great picture for one of the largest revenue contributors for the company here, but ultimately one of the bright spots was energy and transportation, at least here in the North America segment there.
Yeah, tough headline numbers, but when you look at that record backlog growth, that's what analysts are pointing out in their notes this morning, that $5 billion in organic backlog growth, meaning that future demand might be strong, which is a good indicator for a company that's obviously impacted by government spending on things like infrastructure. That has obviously come down under this administration, and that may be why you're seeing these shares pop back and forth between the green and the red this morning. That backlog growth number, a potential positive in this print. Well, coming up, Norwegian Cruise Line's warning of softening travel demand. We're taking a look at what's ahead for the travel sector next.
Shares of Norwegian Cruise Lines falling after the company missed Wall Street's expectations in the first quarter. Norwegian saying it's seeing some softening in future bookings here, but plans to offset any weakness with cost-cutting measures. While the company maintained its full-year guidance for profit, Norwegian broke from its peers Carnival and Royal Caribbean, which both raised their outlook for the year. I want to bring in James Hardiman, who is the Citi Leisure Travel Analyst. James, good to have you back on with us. Just take us into your analysis and how Norwegian is differing in their business right now, but perhaps in a more extreme and unfortunate position than some of the others that have already come out.
Sure thing. So, first off, I think it's worth noting that the first quarter was a good quarter for these guys. They beat on the EBITDA line. EPS was a little light. That was 100% due to an FX charge, without which they would have beaten on the EPS line by a couple of pennies. With respect to the outlook, I think what has people spooked to some degree is the idea that they said that they did see some softness in bookings, particularly in early April, because of course they did, right? I mean, early April characterized by Liberation Day and just sort of that maximum point of anxiety, fear, and uncertainty. You know, people aren't going to be out there booking summer vacations. What they did tell us that in the week since, and particularly over the past week and a half, we did see some improvement, and that we're back to sort of the late March level of bookings, which is exactly where they want to be. I think the biggest difference between Norwegian and Royal, who reported last night and really didn't talk about the same level of softness, or any softness for that matter, is just the level of slack that they already had in their numbers, right? I mean, I think we've heard enough from various travel companies, really kicked off back in mid-March with the airlines, who sent shockwaves through the travel market with their negative comments. I find it hard to believe that travel consumers broadly aren't, or at least weren't, taking a pause at the beginning of April. I think the difference is the momentum in the business at Royal, which is, you know, on so many levels the best in class, was such that they were able to look through that and not flow that through to their reported guidance or their stated guidance, whereas Norwegian had less slack in the numbers and ultimately had to.
So let's zero in on that consumer behavior then, because obviously that's what's weighing on the stock. To your point, what does it take for that consumer behavior to roil back in for Norwegian? If they were pausing off the back of tariffs being announced, what gets them back to spending on cruises?
Yeah, I think it's just uncertainty in the current environment. And again, I think it's really encouraging that following what they spoke to being, you know, softness in bookings, choppiness in bookings, you know, whatever adjective you want to use in early April, that we have seen some improvement in the last week, such that, you know, if we stay at the current pace, we should be in pretty good shape with respect to not only the 2025 numbers, but the 2026 numbers. I also think it's worth noting, you know, this is one of those mornings where it's really hard to tease out how much of a stock reaction is a function of what's going on in the broader market, right? Yeah. My whole screen is red, given that these are all discretionary companies. Nobody needs any of this stuff, right? And cruise companies in particular have some leverage, although the leverage position is much better than it used to be. Yeah. But ultimately, there's news out, right, on the cruise industry, and it's perceived to be bad news. I haven't talked to anybody this morning that is remotely surprised by what Norwegian said today.
James, we got to leave it there, but really appreciate you joining us, and we'll get you back next quarter for a little bit longer conversation. Really appreciate it. That does it for Morning Brief. Stick around for more.